Compounding is like growing bamboo. It grows slow at first and much faster later on. In this video, we will introduce 3 fastest ways that you can compound your portfolio and make you wealthier over time. We will also show you 3 compelling examples that give you returns from 66 to 270 times. And the last example can potentially make you an extra $2.6 million by just investing $10,000. Let's get started. The first way to compound your portfolio is to invest in companies with high return on invested capital, or ROIC. This metric evaluates how profitable a company is, or we can say how efficient a company is making more money by the money it has. Just like farming, people evaluate how many pounds of produce each acre yields, highlighting the company's capability to maximize its financial resources. For example, a company borrows money from a bank at an interest rate of 6%. At the end of the year, the company makes a 10% return from the borrowed money. Then, we can say the ROIC is 10% minus 6% equals 4%. If the company earns 12% by the end of the year, then the ROIC increases to 6% in this case. Now we can see, the higher the ROIC, the more profitable the company is. The more profits the company makes, the higher return the investors receive. Now let's see a real example. Coca-Cola. In 2019, the company had an ROIC of 10.67%. We can see this metric is growing every year. In 2023, the ROIC went up to 14.14%. How about PepsiCo in the past 5 years? They are about the same. So we can say both Coca-Cola and PepsiCo are all profitable businesses based on the ROIC. Some of the best companies that have great ROIC are Darden Restaurants, Apple, and Best Buy. Darden Restaurants have an ROIC of 11.43%, indicating a strong return. Fundamentally healthy companies like this often pay good dividends and have certain dividend growth year over year. Also, they are exhibiting significant share price appreciation. Darden Restaurants have a dividend yield of 3.53%, and the dividend growth rate is 10.28% per year in the last 10 years. Most importantly, the stock price appreciation is 241.96% in the past 10 years. So, each year, the growth rate is 13.08%. For a $10,000 investment, the investment would become $38,741 with an annual dividend of $1,059. In 20 years, the investment would grow to $163,590. Now the annual dividend is $3,367. In 30 years, the investment would grow to $655,907. At this point, the annual dividend is $10,161. Thanks to the high ROIC, the initial investment can multiply 66 times over a 30-year investment period. In fact, there are multiple ways a company can increase ROIC, like selling unproductive assets, speeding up inventory turnover, increasing profit, and acquisition. Acquisition is buying other companies. However, acquisition is not always beneficial. If a company can grow organically and make strategic acquisitions to support its growth, then it is reasonable. Otherwise, constantly buying more companies is not a good move. Therefore, it is a good practice to check the company's acquisition before adding it to the portfolio. The second way to compound your portfolio fast is to invest in companies that do stock buybacks. When a company buys back certain shares of stock, then the existing shares in the market decreases. This reduction in supply makes each remaining share more valuable, often leading to an increase in the share price. Companies typically buy back shares when they believe their stock is undervalued. This process mirrors the basic principle of supply and demand. When supply decreases, prices tend to rise. Let's take a look at an example to see how buybacks can lead to share price appreciation. If a company has 10,000 shares of stocks in the market, the earning per share is $3 and the price to earning ratio is 12. Now we can see the share price is $3 multiplied by 12 equals to $36. So each share is $36. Then, the company buys back 5,000 shares from the market. So, only 5,000 outstanding shares are available in the market. At this point, the earning per share becomes $6 because we have fewer shares to distribute the same profit. The price-to-earning ratio is still 12. Now the share price is $6 multiplied by 12 equals to $72. The share price has doubled from $36 to $72. This example is a little extreme, but we can see even a small buyback can result in share price increase. For a healthy company, buybacks can significantly benefit investors. However, just like picking companies with high ROIC is not always advantageous, companies buying back shares are not always beneficial to investors in the long run. Buying back shares directly influences earning per share, as reducing numbers of share outstanding can increase earning per share, often leading to a higher share price. It is always necessary to make sure the company is financially sound and it is conducting buybacks for the right reasons, such as long-term growth, rather than merely boosting the share price in the short term. Investing in companies that buy back shares responsibly can lead to sustainable gains for investors. Now let's see an example of Accenture, a global professional company that offers a wide range of services and solutions to the clients. The buyback yield is 1.3%. It shows the company's effort to buy more shares back and the expectation of raising its value. This helps the stock price growth and benefits the investors. In the past 5 years, the stock has increased 75.75% in share price. Look at the stock further back. The stock has grown 285.18% in the past 10 years. It shows a long-term positive growth. This is equivalent to 14.43% per year in growth. The dividend yield is 1.68% and the dividend growth rate is 11.11% per year. If you invest $10,000, in 10 years, this investment would grow to $37,745 with an annual dividend of $468. In 20 years, the investment would become $159,471. Now the annual dividend is $1,411. In 30 years, the investment would be $656,080, and the annual dividend is $4,140. Accenture's share buyback results 66 times in return. Now, let's take a look at the last strategy that compounds your portfolio fast: dividend reinvestment. Dividend may not seem significant for every share you own unless you have a large number of shares. Otherwise, the dividend payment cannot even cover a cup of coffee. Don't underestimate the small amount of dividends. When you reinvest this insignificant amount, it will buy you additional shares. More shares mean bigger dividends in the next payment. Keep repeating this cycle. You will get paid a much bigger dividend years later. That's the power of compounding. It's like if you make 1% progress every day, you will be 38 times better after a year. Anything small can make a difference. Some of the best companies are Domino Pizza, PepsiCo, and MasterCard. They are paying great dividends and have sizable dividend growth. High dividend growth can accelerate your investment. Now, let's see how Domino Pizza performs. The current dividend yield is 1.16%. This may not seem impressive. The dividend growth rate in the past 10 years is 19.72% per year. This is amazing. More importantly, the past 10-year share price appreciation is at an outstanding rate of 618.96%. This is equivalent to 21.81% per year. For a $10,000 investment, your portfolio would grow to $63,864 after 10 years. It's 6.4 times growth already. In 20 years, this investment would be $493,318. Now the return is 49.3 times of what you originally put in. And after 30 years, This investment would become $2,698,961 with an annual dividend of $23,635. Each month, you would receive $1,970. Thanks to the power of compounding, the return is 270 times of the original investment. Even with a lower dividend yield, high dividend growth rate helps to accelerate your investment growth in the long run. Buying stocks with high ROIC, investing in stocks with a reasonable buyback plan, and reinvesting dividends are the three fastest ways to compound your portfolio. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.